Jason Barsema, co-founder and president of Halo Investing. Jason, let's start with what to expect going into 2019. I know that this month, we don't have very many trading days left. So what do you think is going to happen come January? Are we just going to see a massive sell-off across all markets?
Well, I think that the S&P 500 and the Dow are going to catch up to the NASDAQ. We've been saying that January through March, I think there's going to be some epic volatility, more for the reason of people are going to be headline watching, such as the Fed, who's watching headline by headline, and it'll be interesting to see what they do. You have Brexit coming up in March, and then you obviously have China and U.S. coming up in February, March. It's going to be a really interesting 3 months and expect a lot more volatility.
Yeah, very good point that you do have so many headlines right now, and it's adding so much to that volatility. But I want to bring in Ian. We have another guest right now, Ian WIshingrad. He is here. He's a tech analyst. Ian, let's start with some of we know the tech sector really brought down, the NASDAQ brought it into market territory. Often when we see this volatility, people move away from tech given high risk, some say overvalued. Is it time to just stop investing in the acronyms?
Yeah, I think for a little bit. Some of the ones, I think, like, for instance, they're not really all on the same plane. So if Amazon kills it with the holiday sales, that's a fair thing to do. And Facebook's the one embroiled with a lot of issues here. So I'm not really sure what people are going to do. I have a feeling things this week are going to be kind of chill. There's going to be a lot of tech IPOs next year. And I think also, remember, these tech stocks led the entire incredible market this year, so they're kind of brought it back down. So I think everything is just kind of a really fair correction.
Jason, we were just talking about all the various headlines, and if we head into the into the new year, a lot of earnings are going to be coming out. Do you see this increase in capital expenditures, but not to the point of improving productivity and improving the workplace, but rather just to inflate the stock price higher with buybacks?
Yeah, I do. I think the two keys for next year that will help at least buoy the market a little bit is increased CapEx, as we saw in the Empire Manufacturing Survey last week. And then also, I do think buybacks they're going to make a charge next year. I don't see increased dividend growth to be a major driver. And if you look at the market and we take a step back, yes, there's a lot of headlines, but there's always headlines. Like, name me a quarter a year where there isn't some macro risk or stinker on the table that we're all worried about and that we're all talking about on TV. I think when you look at valuations from the market and you look at some of the earnings that you were just talking about, consensus is around $173 for the S&P 500. That's lower than a 14 multiple right now, and I think equities could start to look a little attractive barring some of the macro headlines.
Yeah, good point. I'm going to bring it back to Ian right now. Ian, we talked about the acronyms in Facebook, and I know that it's very topical because there always seems to be another scandal that's hitting this company. Is this an opportunity to get in? Should we ride it out a little bit? What are your thoughts specifically on Facebook?
So Facebook, we don't know. They just keep dumping more news, and I think then the big next headline is going to be that they're going to get regulation. I think that's going to scare people. So I would sit out of the stock right now. Overall, the company still makes a ton of money. I'm in the advertising world, and that's where most advertising dollars go, between Google, Facebook, and now Amazon as a third person to the triopoly. So I'd sit out for a little bit. We don't know really what's going to happen here, but at some point it'll be a nice stock again.
Jason, I just want to end with you. You commented in your note that you had seen an influx of guaranteed structured notes. So what is that telling you? That people are just really being cautious heading into 2019?
Well, to be specific, they're looking at structured notes that give them a substantial level of downside investment protection. So basically, they're getting a fixed return of about 13% per annum. So they're locking that return in, and they're making the bet that the market won't fall another 30%. So they get the 13% no matter what. And as long as the market doesn't fall by another 30% from these levels, they get their original investment back. If not, they're fully exposed to the loss of the market, which I find really compelling. I mean, given that we're almost in bear market territory across the board, that's a 50% decline from